This is the Monday Call, brought to you by NZ Funds. Over the past 3 months, financial markets around the world have continued to be volatile. Share markets have pulled back after a rally, inflation continues to be a big story, and commodity prices from natural gas to corn are forcing governments and central banks to rethink policies. James Grigor, Mark Brooks and Andrew Curtain from our investment team discuss the big themes that have been shaping markets and review our own performance. Was the share market bounce a bear market rally? What's the state of play for crypto assets? Why are food commodity prices rising? And how bad will Europe's energy crisis get?
Good morning and welcome to the Monday Call. Every quarter or thereabouts, the investment team at NZ Funds give an update on markets, our views, how we got here, and perhaps a little bit of crystal ball gazing. And so, without further ado, I'm James Grigor, Chief Investment Officer at NZ Funds. On my left is Mark Brooks, Head of Income and Portfolio Manager. And on my right is Andrew Curtain, Head of Research and Portfolio Manager within the Inflation and Growth Strategies. So, guys, thanks for taking your time this morning to have a chat. Basically, we do this every day anyway, so it's kind of like you've got the insights into our morning meeting. But a lot is going on, and I think this year we're 9 months in now, 8.5 months in. It's been a year of volatility, changes and structural changes in things like interest rates, inflation. We're starting to see movements in currency. Shares don't really know what to do. So let's try and unpick how we got here, and then perhaps we can, once the coffee kicks in, take a step back and do that crystal ball gazing and see what we think is going to happen over the remainder of the year and into next year. But let's set the scene first, and I think the biggest driver of what's going on, and I think everybody who's listening would agree with this, is inflation. Inflation was only going to be short term, it was only going to be transitory, and inflation in 2022 really wasn't going to be an issue, and that's what Fed Reserve, that's what a lot of central banks were saying last year. And boy, they were wrong. We've got inflation in the high single digits in a lot of developed markets. A lot of emerging markets, we've got very high inflation, and places like the UK are predicting inflation of 18 to 20%. And that means a lot of changes in the structure of the economy. How do you fight inflation? What has to happen? And so I think the best thing to do is go to first. Let's go to supposedly the defensive side of the portfolios, the fixed interest or bond portfolios. And Mark, do you want to sort of explain what's happened, I guess, since halfway through last year that's mean that there has been a big change? What's going on with inflation? How do we fight it? And what does that mean for your part of the portfolio, the bond portfolios?
That's quite a short question.
Yeah, so and you've got 3 minutes.
Starting now. What has happened? Well, I think everybody clearly knows, as your intro says, James, that inflation's been ever present, and ultimately that has been really bad for fixed interest markets, in the sense of some of the worst returns really on record. And at this point, New Zealand's generally fared okay over this year, mainly because we started raising rates, or the Reserve Bank started raising rates much earlier than everybody else. But bond markets, corporate bond markets are down sort of 4%, whereas the government bond market is down closer to sort of 8 to 9% year to date. So deeply negative numbers. And then you go to the US, and that is sort of, large double digits, sort of 13, 14 type numbers, depending on which day you take it from. So, and that's really a reflection of, one, the inflation. That inflation's been strong and certainly not transitory. More recently, it's also been that central banks around the world have been very focused on trying to get that inflation under control. So whilst the Reserve Bank started the process and have been very forceful with raising their interest rates, that path has continued. Even overnight, as we sit here, the ECB, which frankly never didn't change rates at all, kept negative rates for a very long time.
That's the European Bank, isn't it?
Yes. Yep. Raised them by 75 basis points, and you've had the Fed do that twice. It's everybody used to talk in 25 basis point increments, but now 75 is the new 25. And in terms of inflation, I think it's interesting. You went through those different economies, and this inflation in the developed world has been very present. What is interesting is you do have two large economies where it is not really an issue, being China and Japan, and we can get into that later. But I think what is important in terms of New Zealand, Australia, Europe and the US is how that inflation's been made up. It's high everywhere, but it is different, and there are some nuances. And in New Zealand and in the US, you have super tight labour markets. Anybody here who drives around, walks around the shops, will see help wanted signs. Very similar, it appears, in the US. I think, in terms of jobs on offer, there's something like 9 million jobs on offer. 11 million jobs on offer at the moment, and the unemployment rate's 6 million. So you have a gap of 5 million people that they're looking for. So that definitely creates wage pressure, and same here in New Zealand. And that says to us, and probably I'll come back to it later, but because of those sorts of factors, that it's going to be really hard to get inflation under control. Maybe in Europe it's a bit different because they've got a massive energy crisis, which I'm sure Andrew will touch on, and that is driving their inflation. They don't seem to have the same wage pressures that we do. So some quite different dynamics at different places.
Mark, we hear a lot of the central bankers talking about not wanting inflation expectations to become unhinged or become embedded in the economy, and they use references of certain, the general person and the public expected inflation, and they're concerned about that. So why are central bankers worried about it becoming embedded in the economy?
Yeah, it's interesting. I saw a piece, I think, from the Federal Reserve Bank of Chicago, a research piece, and they made the point that when you break down what drives people's wage thought process, clearly it's things like, well, what am I getting paid today? But go back pre-pandemic when labour markets generally weren't as tight. Inflation and their expectation of forward inflation actually made up quite a small component of that. But their research suggests that since the pandemic, because people have seen inflation and actually have had this cost of living, 8, 9, 10% cost of living hit, they are actively looking to recoup that, and that's front of mind. So it actually makes a big, it is a big component of how people think about, how am I going to get paid? And it's also a component which has got a long half-life to, in sort of a radioactive point of view. If it's there, it gets embedded in their thinking, and that's probably the short answer, is they're concerned that it will get embedded and that will become, it'll just be very sticky and stay around for a long time.
Why is inflation bad per se? I guess there's a number of ways to unpick that. When you talked about the energy crisis in Europe, energy prices in, say, the UK are up 80% this year. And Europe is the same on the continent, at the same time your interest rates are going up by 75 basis points. So you can see that cost of living squeeze both on your interest payments if you have debt and your general day-to-day living. So there's a real consumption squeeze. But when you think about the asset classes that we invest in, what's happening to those bonds in an inflationary period? Because if I look at some of the index returns in, say, global bonds are severely negative, down over 10% year to date. So why are they doing that? What's going on?
Well, again, I think it is about all assets come back to what cash flow does this asset generate, be it a rental property, be it a bond or a share. And one of the nice things about shares is that actually companies earn nominal earnings. So if inflation is up, actually company earnings will probably be rising as well. Maybe not as fast in different sectors, but they'll definitely be rising. But if you've got a bond, and most 99.9% of bonds are fixed rate coupons, so you get paid a fixed amount. So from that point of view, if the value of money is falling, essentially you've got to run harder to keep up with that. And if you're only getting paid a fixed amount, then you're more likely to be going backwards.
Which is always scary for the defensive part of the portfolio. So, but don't worry, you can, and we'll cover this a bit later, I think. But don't worry, you can invest in cash. The problem with cash is you're starting at a negative 9% return from the start because inflation's so high.
Yeah, and I think if you turn it around, cash is going to go backwards, but equally it becomes sort of why it's bad. And if we think back to last year or the year before when tech stocks were the focus and everybody wanted tech, in a way that was because interest rates were zero. So the fact that a tech company, maybe a Zoom or something like that had no earnings, but was likely to make earnings or expected to make earnings in 10 or 15 years' time, if interest rates are zero, you don't need to discount that because the earnings in 15 years are basically the same as earnings today. But if you've got, in the extreme 9 or 10% inflation, after that, earnings in 15 years are going to be a pittance of what they would be today. So
the value of those companies
correct
massively decrease. And I guess this is a great segue into, don't worry, bonds are under pressure, but equity markets are fine. They're tracking upwards. Oh, wait a minute, no, they're not, because they get a whole lot of volatility too. Andrew, do you want to give a bit of a summary on what's happened with the reaction of share markets given the high inflationary environment, which actually doesn't have to be necessarily bad for shares, but the reaction function of the central banks means that shares also, as Mark just alluded to, struggle in that aggressive rate rising as well?
Yeah, sure. So why don't we maybe start by setting the scene roughly where the share markets are today. So if you look across sort of the major indices relevant to us in New Zealand, which is both the Aussie and New Zealand indices, but we also follow quite closely what's happening in Europe and the US. So the New Zealand market is currently down 10% year to date. That's calendar year to date. Australian market slightly better, down 8%. If you go to the US markets have actually suffered a little bit worse so far this year, with the major indice, or the most well-followed indice, the S&P 500, is down 16%, and then the technology-heavy index, the Nasdaq, is down 24%. The ranges that you've seen really over the last sort of 3 to 4 months has been, most indices have been trading somewhere between down 25% for the year, and then the sort of bouncing to these levels that maybe 15% above that, so only down about 10% for the year. And it's been a little bit range bound for the last couple of months. And I guess to James's question, why are we starting to get into this range bound level in the share market? I think the reason for that is that the most clear part of the sell-off in the share market is largely behind us. I say largely because we're not certain, but it's starting to become more well reflected in the market, and that part of the sell-off is the higher interest rates, higher inflation sell-off. So what happens when, as James sort of alluded to and Mark's alluded to, when you're looking at tech companies, if interest rates and inflation goes higher, typically investors will pay less for companies, and that is because the value of those future cash flows becomes less. So that means your value today that you're willing to pay for the company also has to come down. The best way, or the most easy way to look at that, is through what's called multiple compression. So you look at a price to earnings multiple of a company, which is simply its market cap divided by its net profit. And so a range that companies were trading at coming into the start of the year might have been around about 24 times, 23 times price to earnings multiple at the start of the year, which historically is quite high levels. So depending which market you look around the world, the long-term averages might be about a 17 times multiple. So we were probably trading at levels sort of 6 to 7 times above the long-term average, quite extended. Haven't seen those valuations probably since the end of the dot-com era back in late 1990s, early 2000s. And so the market was pretty quick to react when inflation went higher and interest rate expectations went higher to bring those valuations back down to more normal levels. And that's really what we saw About 3 months ago, these valuations came down from that sort of 24 times level to about 17 times. Now we're entering, a more complex part of analysing the valuations of companies, because people are sort of saying, look, we know inflation's high now, and we've gone and appropriately taken the valuations of these companies down to more long-term average levels. Now we need to work out what's going to happen with the earnings of companies, and this is the part that gets quite complex. So on the one hand, high inflation, as Mark alluded to, means you've got high nominal growth levels, which means you typically, as a company, are growing your sales line quite fast. So if you've got inflation running at 9% and your company is not going forwards or backwards, it will grow its sales at 9%, all else equal. It is just passing through that inflation into the sale of its goods, or the price of its goods are going up by that inflation level of 9%. So your top line growth looks quite good. However, adjusted for inflation, you're not growing at all. But what we're currently seeing, particularly in the US, is that companies are still growing above inflation. So the expectation for the US market at the moment is to grow its top-line sales growth by around about 12 to 13%. Inflation at the moment is running, say, 8 to 9% at the moment in the US. So they're still growing really strongly, which is quite positive. But then you get to the second part, which is where a lot of focus or attention has been given at the moment by analysts around in the investment universe, is looking at operating margins. So operating margins at the moment are really strong, which is why people are not too negative on the market. That's why they're kind of relatively
operating margin. You just mean profit.
So operating margin, yeah. So profit margins, yeah. Profit margins are quite strong. These are basically at all-time high levels, but now people are starting to analyse, look, what companies are going to be able to maintain or at least defend these high margins or profit margins in a high inflation environment. And so you're starting to see a little bit of bifurcation in the market, where people are trying to say, look, is this company able to successfully pass through this high inflation at the same time as controlling its own cost base? So let's say you have a company which has got a product which is really desired, people like the product, and I'll use an example, say like Apple. Apple generally has quite good pricing power. People consider it a premium product. People typically would pay an extra 5 or 10% to buy that iPhone. And so if inflation's running a bit higher, Apple can generally pass through the inflation cost. At the same time, let's say if Apple can manage its cost base quite well, so it can manage its employees and not have to pay them 10% more just to keep its employees, because people want to work at Apple because it's such a biggest company in the world with a fantastic brand, and people get great CV or great it's great for their own career development to work there. They may not have to pay to increase their wage levels too much. So if you step back, that could mean Apple is able to defend its profit margins, which makes it quite an attractive company to invest in a high inflation environment. But on the other hand, you might get a company which is, let's say, it doesn't really have much of a competitive advantage. It basically competes on price with other companies of a similar manner. Let's say it's a type of a retailing business. It might be a clothing retailer, and it's the cost of cotton and the cost of various commodities that go into making its products are going higher, so its cost base is going up. Employment levels or unemployment levels are quite low, so they're struggling to get staff to work in their store and sell the products, and so they're having to pay their staff more. At the same time, they're just making a pair of jeans or something, and you can go buy jeans from somewhere else. They can't really put up their price, so they start to come under margin pressure or profit margin pressure, and those are the businesses that people are sort of getting a little bit more worried about at the moment. So
this is a really important point. I think what you're describing is what we've gone from in the past 10 years is we haven't really, if we're really honest with ourselves, haven't needed to think too much about the bifurcation example that you're talking about. We have now entered, and this is what we mean by if you've heard us talk about it before, we're now entering a stock pickers market. There are going to be companies that do well in this environment, and there are going to be companies that really struggle. And that's really exciting. It's not something to be nervous about. Actually, you can identify companies that will really even increase market share or increase their profitability or, dominate their area of expertise. And there'll be some companies that will fail. And you can look at it from a listed company point of view. You can also drive down the street and look at different cafes and cafes is a great example. We're all drinking a coffee. They're all roughly, not totally the same, but pretty much the same, all cost about the same, yet their pricing is going up. Milk prices, wage costs, rent, all those things. And so the ones that can't keep up the volume of people are going to go bust. This is what we're seeing in the listed companies. So when you think about this market, are you starting to get excited, not nervous because of the opportunity set that you can identify and buy? And how do you think about, what are some of the companies that perhaps, or not necessarily companies, but sectors you might start looking at?
Yeah, no, it's a great environment for a stock picker. It's a sort of environment where you feel like the more work you put in, the more you're going to be able to get out of it.
Yeah, we're exactly earning our salary.
for a lot of the for the period where interest rates are going lower, and that's really sort of been over the last sort of 10 to 15 years, an investment strategy which has worked well was basically being able to buy the companies that are growing the fastest. When interest rates are lower, high growth companies get valued better, and so that was
and potentially the ones that are most expensive to start with.
Exactly right. So maybe valuation or sort of accurate forecasting of earnings didn't sort of, you didn't get the reward for the time you put in to do that. As long as you sort of owned the growth sector, you did quite well. Where certainly that's really changing now with what's going on with inflation, and as James is alluding to, analysing which businesses are able to pass through the costs and which ones are going to have the better margins, and therefore which one might grow faster than the other business over the next 12 or 24 months is starting to have a much bigger impact on the valuations of the multiples people are willing to pay for these companies. I was
just going to say, I think the nice thing also is, again, you're starting from a point where actually valuations are pretty fair. So
exactly right. You're the long-term average. So if we look at the average multiple over the last 20 years, I think we're sitting 1 times above that level at the moment for the US market. New Zealand market's a little bit more expensive still. There's a few sort of factors with individual stocks that's driving that. But so you're at a better platform to generate longer term returns. I actually printed off before I came in the best and worst performers so far year to date in the S&P 500 index, which I thought might be interesting. What is fascinating, the top 10 companies are all oil companies, which is there's probably no great surprise that we've seen oil price go up to over $125 US dollars a barrel this year. It's sort of currently a bit lower at about $85 a barrel, but in general oil has performed really well. And if you step back to what I was talking about, ability to put your top line price up but maintain your cost base, well, what better example than an oil company this year where the price of oil's gone up about 100% and they pass that straight through to their revenue line, and their cost of sort of employing staff or getting people to work on the rigs has probably only gone up by about 10% or 15%. So they've just had huge margin expansion.
And there's demand destruction when prices are high, but not that much yet. I mean, we're still probably.
I think we just started touching on it when oil price got to that $125 a barrel. That was the level people were starting to talk about demand destruction, and actually we saw some data out of the US as they went through the summer, what they call their driving season, where they'll jump in their cars and head to their lake houses, and the driving numbers were lower, and part of that was high oil prices are starting to become a little bit restrictive there. But back at $80 or $85 a barrel where we are now, it's not overly restrictive. So those companies have done really well. Another sector which has done really well this year is companies that are sort of in the agricultural sector, particularly in ingredients into farming. So we may touch on this a little bit later when we get onto commodities, but agricultural prices around the world have been going very high for a number of reasons. A lot of it weather, part of it geopolitical factors, but basically the demand for fertilizer or other ingredients into farming has been going really well. So companies that produce fertilizer on mass global scales, they build these $4 billion facilities which process a bunch of inputs and then output products like fertilizer or phosphate, which go into farming, have performed really well, and a lot of these companies are up 60-70%. So I'm not going to go through every sector that's performed well, because there's not too many that are positive this year, but the ones you have seen have generally sort of somehow been exposed to the high commodity price environment.
What you can see, before we get on to the negative ones, what you can see is that the fact that New Zealand is down a lot less than the S&P 500 or the US share market starts to make sense now. We're an agricultural-based country. We're big on food production, and the other so you've got that support of the economy, and then the companies listed on the market are generally ones that have a good that is demanded no matter what the economic environment is. And so it's not perhaps a great representation of the wider New Zealand economy, but I'm talking about things like Meridian Energy. We're all going to probably put our electricity and gas bills at the top of our priority list when we pay after our mortgage and the petrol for our car.
And your internet with Chorus.
And your internet with Chorus, and perhaps your mobile phone bill. And we've got less companies on our market that are growth orientated, and the ones that are kind of defensive growth, like Fisher & Paykel Healthcare, which has a into that medical sector, which is generally can be pretty defensive, although they have come off in price. But you kind of see with our concentrated market that it kind of makes sense that we haven't perhaps fallen as much. But it doesn't mean to say we're any less vulnerable. It's just the makeup of the market. But
it's the makeup of our listed companies. That's right. We happen to be more tilted to companies which have got slightly defensive characteristics, whereas the US, a lot of the companies are high growth technology type companies, which are more susceptible to the environment we're in at the moment.
So which ones have been the worst?
So the worst performer this year is a company everyone will be familiar with, and it was one of the best performers in 2020 when everyone got locked down, which is Netflix. So Netflix had performed extremely well as we came into lockdown. Everyone was stuck at home and so paying more for their subscriptions. But now as we've come out of lockdown, people are sort of sitting there going, well, do I actually need to be paying that for the Netflix subscription? It's not so much that everyone's getting rid of their subscription, but the growth has just stopped. This is a business which has been driven on adding very large numbers of subscribers every single month, and that has basically come to a halt. So the market has now looked at it going, look, we were expecting your earnings to grow at this level, sales be growing at 25-30% each year for the next 5 years, and now we're having to reevaluate that and say, look, are you going to have a year or two of not much growth and then having to do a few other things? And is the cost of producing your shows, the content costs going up because we're in this tight labour market, and all the other input costs that go into making high budget series or films is getting higher. So the market's just going through a reevaluation phase.
What's really exciting about that, though, is as a passive manager, you had to own Netflix. So you got the good times, and then if you were a passive manager, you got the crappy times too, and you felt that entire 62.25% drop in
a company which had a $400 billion market cap, falling 60-odd% is a big move.
Massive. But now, as an active manager, we didn't own it during that drop. And what's really exciting is Netflix still has 250 million subscribers. It's not like they're going to the wall. They are a powerhouse in their sector, and we get to analyse it and research and potentially buy a great company that's now 63% cheaper. It's pretty good opportunity.
They haven't really flexed their ability to put prices up yet either. They could go put their prices up by $2 a month, and most people wouldn't even bat an eyelid and would go ahead and pay it. And so they've got some tricks up their sleeve still to come. So I don't think the company's broken by any means. I think it probably got a little bit ahead of itself in valuation, but a lot of companies got too expensive and sort of back into 2021, and it's probably a reasonable pullback, maybe a little bit overdone, but over time as it sort of gets this sort of growth story going again, it can probably re-rate and trade higher again.
Yeah, I think it's just stepping back, it's a good way to sort of think again about long-term investing. So much of our market is about, or what's the next number, or what's happened this week, and if you step back and think about Netflix as a business, it's just becoming mature. It's moved from a high growth new startup to a product which most people have, everybody knows. Yes, they've got 250, 300 million clients. It's pretty hard to grow exponentially from there. So it goes from a high growth business, the life cycle moves on to a stable growing business. But
a fantastic segue into another company, which is the fifth worst performer in the S&P 500 this year, which is company called Meta Platforms, which is actually Facebook, which has rebranded itself to be called Meta about 6 months ago. So Facebook, exactly what Mark was saying, is a slightly similar story in the fact that it has been a really successful growth story. So this is one of the companies that's the top 5 largest in the US, but it was the fastest company to ascend to that level because Facebook only came around sort of back end or sort of pre-2010. But basically in the space of a decade, It went from a very new company to being one of the top 5 largest companies in the US, which is actually much faster than Apple, Microsoft, some of the other big companies achieved that sort of rise to the largest company.
And its growth came from, I remember when it first listed, how will they ever monetize their subscriber base? I mean, this isn't a loss-making tech company. This is making billions of dollars a year in cash flow.
It's the second biggest advertising company in the world, which a lot of people probably don't realise that. So the biggest is, or the company that earns the most advertising revenue is Google, which makes sense. Number 2 is Facebook. So what's been going on with Facebook? One, probably was just too expensive as well, like a lot of companies did. All the sort of stimulus, low interest rates that we had in 2020, 2021 drove valuations to levels which were were unreasonably high. But the second thing is similar to Netflix, its core product, Facebook, has started to slow down growth and actually had a slightly negative number. They lost some subscribers for the first time in its history. Not all is lost, because Facebook also owns Instagram. It also owns WhatsApp. Instagram is still growing really fast. It's more used in sort of the younger cohort of people, sort of the age 20, 30 to 35 sort of age group. Facebook itself, the blue brand Facebook, is sort of becoming more known in that sort of 30 to 35, 40 plus age group, whereas the younger teenage level people are using products more like Snapchat, TikTok, which are growing really fast. So for Facebook, I think it's got probably a 5 to 10 year transition point at the moment, where they're actually placing a lot of their success, or their bet, which will prove to be either their success or undoing, on the development of the metaverse. So basically what they look at the advertising market as a market that used to go from sort of physical handheld newspapers, billboards. It transitioned onto computer screens, which was the very early days of Google and Facebook, and then moved on to phones, which is where most digital advertising revenue is generated from. Now they're thinking about it's going into 3D, into the metaverse and the virtual world, and that's why they've renamed the company from Facebook to Metaverse, because they no longer see themselves as this company that should be based on one brand called Facebook, and they should be a company that's seen as probably the company that's got to forge the way into sort of everyday action into the 3D and virtual world. Facebook also owns the largest virtual reality and augmented reality glasses business, goggles business in the world. I think it's got an over 50% market share. So it sees itself as trying to lead that transition to advertising revenue and interaction into the sort of online virtual world space. I find it difficult to be long Facebook at the moment, because there's so much uncertainty on the success of that transition. It's very hard to value from our perspective. So at the moment, you've got a core business which is now not really growing, slowly starting to decline, and you've got the future success of the company on a uncertain but exciting conversion of the business into that sort of more virtual world. And so trying to get certainty on what this company is going to earn in the next 5 to 10 years is very difficult for me at the moment. So at the moment, we're preferring to sit on the sideline from an investment in Facebook.
So we've set the scene now. I think inflation is high, interest rates are going up, bad for bonds. Inflation's high, interest rates going up, bad for certain types of companies. Generally, all companies came down, and we've seen that in a spread between markets around the world, or developed markets that we look at, down between 8% in Australia to 16% in the US, NASDAQ down 24%. So we've had a big sell-off in shares and bonds as well. So there was really nowhere to hide, and that 60-40 portfolio that people talk about has been ugly. And at the same time, or if you move to cash, you're down 8% this year in terms of your wealth, because that cash is being decimated by inflation. Probably the most dangerous asset class to be in at the moment because of the inflation rate. So what do we do about that, and what have we done within NZ Funds to be able to mitigate some of this? So we've mitigated the fall in bond prices and the fall in share prices. So, Mark, do you want to talk through perhaps how you're positioned in your portfolio and how you think things are going to play out? Get the crystal ball out. No one will. This isn't recorded. Oh, wait a minute. Yeah, it is. So, but how do you see things playing out within the bond market? What should investors be thinking about, and what is the opportunity going forward?
Yep, cool. I'm an economist by training, so it probably means I will give you 2 or 3 answers. Always trying to spread those bets. Look, I think, from an inflation standpoint, that is clearly driving where interest rates are, and we are generally at a very big picture view that there are some structural factors out there that is going to keep inflation higher than it's been. It's not going to remain at the 8 or 9% level, but we are of the view that, or I think 3 of us are of the view that, inflation in 3-4% is probably more the norm than 1 or 2, and the reasons for that.
And that's quite a big difference.
Yeah, and it certainly means that interest rates, we're not going back to interest rates of 1 or 2. Interest rates are more likely to be 3, 4 or 5 in the next 5 years. And why is that? Very quickly, I just think there's a couple of very big structural factors. One of the biggest is actually government spending, and not to say that's a bad thing, but governments around the world have a mandate to spend money. And it's interesting, some academic research recently presented at the Jackson Hole Symposium of Central Bankers that suggested that if you look back through history, when you've had sticky inflation, generally that has only been brought under control when both the central banks are running tight monetary policy, but also governments are running relatively tight fiscal policy, so restraining their spending, running budget surpluses, etc.
And it doesn't mean just to say not spending money. It's also, look what's happening in the UK. There's 133 billion spent on trying to, bail out the public with energy, but at the same time tax cuts.
Yeah.
And so tax cuts are massively inflationary because most people will probably spend that, causing
and,
inflation.
And very rightly so, like the energy bills, etc., they're probably pretty necessary, and the government should be doing that. But it just sort of says you have this sort of tug between central bank actions coming one direction and actually government spending pushing the other way. So, there are other things such as the deglobalisation and decarbonisation all adds a little bit of cost and just raises that inflation tide. So, generally, probably our medium-term view is that interest rates will continue to bubble up. So that is a challenge. But on the flip side, the nice thing, again, a bit like equity markets being much cheaper, is actually your starting point in bonds is really good. If you think about a year and a half ago, you were starting with interest rates at 1%, 1.5%. Now you're starting, the base on your bond is 4%. And then there's, if you buy a corporate bond, there's a credit spread above that. In the extreme, if you're buying some of the riskier high yield names, in the US, say, they're starting at 8%, even 9% yields, whereas that was 4.5%, 5% a year ago. So that's a pretty exciting space to actually, for us to, for the first time in a long time, if we sort of look, if we look through the different asset classes, I think all of us can say there's actually a decent opportunity set to start with.
So you were able to mitigate that downside risk by making sure we had a portfolio that wasn't affected by raising interest rates. In fact, you didn't just mitigate it, you generated significant alpha within the income strategies. If I just look at the KiwiSaver income, for example, is up sort of close to 14% in a market that's down sort of 8 or 9%. Done in a way because we've just had big moves in interest rates. So if you're able to avoid that, then that's been fantastic. And now you're starting from an incredibly strong base to then buying bonds, which are now finally giving you a yield return, because we might not get capital values like we did in the last 40 years, but you're getting a good yield, and that's the whole point of a bond.
So your starting point, and again, at that very simple level, if you come back to sort of the returns you naively want from your different asset classes, bonds probably 4 to 5 for a very high quality bond is your kind of starting point, and that's where we are. That's a much better place to be than at 1% or 2%.
And that takes money out of the share market into the bond market, doesn't it? It's a self-balancing mechanism. When interest rates are so low that you're not getting a good return on owning bonds, people will take it out of the bond market and they'll put it into the share market, which is exactly what we saw happen in 2020 and 2021, and that helped drive the valuations in the share market higher, and now we're probably at a point we start seeing it move back the other way.
Yeah, and I think, often clients will say, well, isn't there, there's war in Ukraine, there's inflation, etc., but without being too flippant, and not meaning to dismiss the war in Ukraine, that there's always kind of something going on. And the nice thing now is actually your initial sort of recompense or payment for taking that extra risk is a much nicer starting point. So there's a great set of opportunities for us, I think.
So we've done two things within the growth and inflation portfolios, Andrew, to generate a return that's in the growth been positive for the year, and in the inflation portfolios really quite positive in the year. So again, using KiwiSaver as an example, KiwiSaver inflation is up 7-8%. These numbers are going to change daily, but this is sort of hot off the press. And growth portfolios are up just under 2% year to date. And these are versus the market, which you explained before, down between 8 and 16%, and the Nasdaq down 24%. But there's been two real drivers of that. One is the mitigation of that using some of the tools that we've got in our toolbox that we haven't really needed for the past 10 years, but are now coming right at the forefront of helping us mitigate that downside, which is using options. But the other one is the fact that we can diversify out of shares and into commodities. So do you want to, those are two pretty big topics. Do you want to touch on how we think about downside mitigation, but then let's move on to commodities and think about, I was just checking the time to see, because commodities is a big part of what we do at the moment around generating returns outside just your base asset classes of shares and bonds.
Yeah, sure. On the downside mitigation part of it, I almost sort of split it into two parts. One is, first, you always need to think about stock selection. And if you're in an environment where we think the markets are looking expensive, might sell off, or what you generally want to do is rotate your exposure to the companies you think are going to be more resilient in that sell-off. And part of it is what we spent about 15 minutes talking about before, which is owning the companies which are going to have the best earnings resilience against a high inflation environment. But also part of it is going to companies which are more defensive in nature and safer companies that tend to be less volatile. So that can be your Meridian Energies and your utility type companies, your infrastructure type businesses. You generally want to sell your technology, your sort of riskier, higher valuation stocks. So that's the first thing we did this year. We've generally done a good job in not owning the companies that have had those 60 or 70% falls because they were too expensive and higher risk. So we've sort of mitigated downside through doing that. The second part is we've used a mix of futures and put options to sort of hedge against the downside moves. So I won't go into a huge amount of detail, but options are basically a form of insurance. You pay sort of a premium, and it pays out and protects you if the market falls. So, for example, the S&P 500 at points has been down over 20% this year. You might spend 1% of your portfolio on a put option, and if the share market falls by 20%, that 1% might generate you 7 or 8% of value in your fund. So it might offset nearly half of that downside.
And if it doesn't, it's just like your car insurance premium, it falls away.
Exactly.
It's not a big cost.
Exactly, and it's not a strategy that works in markets that are grinding higher and interest rates are low and markets are sort of doing 10 or 12% upwards each year. The strategy doesn't work in that environment. But in a market where markets have done a very quick run-up, like they did in 2020 and 2021, where share markets popped over 40 or 50%, valuations got expensive, inflation started coming on the scene, interest rates were going higher, we were able to buy protection, this option protection or insurance at quite attractive levels, and that's been a successful strategy to date. It's been more successful in the sort of first 4 or 5 months of the year, as the market sort of hit this more, what I referred to before as range-bound environment for the last few months. The strategy, it doesn't work as well in that environment, so then you don't have to use it as much. You just back off on it. You don't spend as much on that protection.
And when you think about what's going on, perhaps geopolitically, but also when I reflect on COVID and 2020 and 2021, we wrote a lot of articles. We're at home. We're writing a lot on different things we're seeing in the market. And one piece that you wrote, I think it was in 2020 or was it in early 2021, was around this commodities super cycle and the fact that, and this was well before conflict in Europe or anything like that, it was really brought upon by this ESG and green energy policy that Europe and the US, but most countries around the world, including New Zealand, were taking on, and that really meant there was this what was turning out was this big supply and demand imbalance in commodities. Talk us through that, and perhaps let's then focus on some of the interesting ones that we're looking on at the moment to, again, generate returns that not just reliant on what share markets are doing.
Yeah, sure. Commodities is a very fundamental market. It's at its most simplest. It's simply the supply and demand of a certain type of commodity will dictate the price. It's very simple. You pull a commodity out of the ground and it gets used in a manufacturing process to build something. For example, copper gets pulled out of big mines which take 5 to 8 years to build, and then that copper gets taken and it gets melted and turned into cables and goes into windmills and goes into electric cars and goes into houses. And if you look at most commodities around the world, that's at its simplest how it works, which means they go through cycles. You get periods where commodities have got too much supply and demand is not enough, and so the price goes very low. And then you get periods of vice versa where demand gets really high and the supply is not there and the prices go higher. So the last commodity super cycle, and commodity super cycle is a term that's thrown around a bit, but generally sort of means a decade.
Sounds good.
Exactly.
Another way to describe it is commodities are boom and bust. Because it just takes so long to open a mine that by the time everybody spent all their money to open it, the price is sort of already too low.
That's exactly right, and that's why you tend to get this sort of the super cycle, sort of a 10-year period of higher commodity prices, and after that 10 years, generally the supply is caught up and the prices tick lower. So the last period was sort of early to mid 2000s, which was when China and to a lesser extent as well, South America were really coming onto the international trade market. So you had these massive population bases which were producing goods at very cheap prices because they had cheap labour, and so they were just buying commodities. They were getting iron ore, they were getting copper, they were taking all these commodities out of the global trade market, producing goods and flooding those goods into the market. That's when China really came into the market. So it just put this structural demand change onto the commodities market, and the commodities market couldn't keep up.
And that's really the key issue, isn't it? That yes, it's a demand and supply market, but actually it's really about that inability of commodities to change their supply curve.
Exactly. You've done work in the copper sector, haven't you, Mark? And so how long does it take to bring on a new copper mine?
Oh, at best 8 years, but now with environmental rules, etc., it could be even longer. So, whereas producing another version of Microsoft Windows takes half a second or something.
Exactly right, and so I guess bringing it back to sort of today, because we can talk about the history of commodities for a long time. You had that sort of China-driven commodity supercycle which peaked in sort of 2007, 2008. At that time, the financial crisis hit, demand slowed, growth slowed. At the same time, all this capacity had come online because people had been frantically building it for 10 years while this sort of supercycle was going on. Flipped everything the other way. You went into sort of a 10 to 15 year market where you had too much supply, not enough demand. Commodity prices all around the world are sort of have been at lower points. Many commodities aren't even near the levels they got to back in 2007, even now. And so you sort of had this period where people didn't want to invest in any capacity. Roll forward to COVID. Post-COVID response, massive fiscal stimulus from governments everywhere, supercharging a demand boom across for all sorts of goods and services and commodities. At the same time, low interest rates, easy monetary policy. So we've had this fantastic period of economic growth over the last 18 to 24 months. But the capacity is not there. You haven't had this investment in supply. So generally, most commodity markets you look around are relatively tight compared to historical levels, and that's driven this upwards boom. But to sort of tie this into sort of how this has impacted our portfolios this year, there's been a number of commodities we've invested in, right across energy commodities through to metal commodities like copper and aluminium, through to agricultural commodities like corn and wheat. Towards the end of last year, while demand was still really strong, interest rates are quite low, we basically owned a mix of all of those. We owned a little bit of oil and gas, we owned some agricultural commodities, and we owned some metals. Roll forward into February this year when the Ukraine war broke out, and between Ukraine and Russia, both of them are very, very large exporters of commodities around the globe. It's supercharged a big uptick in the commodity prices. So we managed to, in our growth and inflation portfolios, we managed to harvest some really nice returns during that period. And we also managed to lock in a bunch of those returns in sort of March and April after the initial pop higher. We managed to decrease our positions. Rolling forward today, it's a little bit more complex. You've still got relatively tight demand-supply chains. However, there's a growing concern of a recession coming out at the moment. We don't know whether we will in fact have a proper recession. Technically you can say two negative quarters of GDP growth is recession, but then the economics experts around the world say no, you've got to look at labour numbers and all sorts of other things. So it's a little bit uncertain, but it's created nervousness, particularly because China is a country that is slowing down, and China is so important. So what does that mean? You want to be a little bit more careful owning cyclical commodities. So these are commodities which are susceptible to a slowdown in economic growth. So that's your oil, that's copper, that's iron ore, that's even aluminium. That's anything that sort of as construction and just growth slows down, that the demand will fall. And what you probably want to own is commodities which have still got very tight inventory levels or stock levels and are not really susceptible to a slowdown, which is your agricultural commodities, such as corn, wheat, soybeans. And so where we're sitting today is we're not long in other than a small position, moderate position in natural gas. We don't own any of the other cyclical commodities, and we have our exposure.
And that natural gas is more of that decarbonisation out of coal into gas. So this is a long-term theme, not a 3-month type of investment.
And the situation in Europe where you're basically not getting the gas out of Russia, and Russia supplies most of the gas into Europe. So there's a very structural thing going on there. We're probably running out of time to talk about natural gas for too long. So
that's probably lucky.
I'll finish off by saying the agricultural market's interesting at the moment because, for example, in corn, Ukraine exports about 16 to 18% of the world's corn. Only a small percentage of that's going to get into the global markets this year, which is actually very sad for a lot of countries, because a lot of that corn goes into North Africa and Middle Eastern countries that really need it. On the positive side, at least Russia's allowing some boats to get out to get some of that corn to market. But at the same time, we've had 3 years of La Nina effects, which has meant lower rainfall levels in some countries, particularly the United States, which is one of the largest producers of corn. So their crop levels and harvest levels have been quite poor there. So basically we're heading to levels which are towards the lower end of historical levels of sort of spare stock of corn, and that's putting upwards pressure on the price there.
Great summary, Andrea. And it's a big sector. We could talk for, like you said, hours on commodities. There's one more asset class I wanted to talk about, and then I was going to do a couple of quick-fire questions just to put you guys on the spot. But currency is something that really can be pretty sleepy at times. But at other times, like we're facing now, when Mark, you described it as the least dirtiest shirt. And what we mean by that is economies around the world, as Andrew kind of alluded to, are all at the perhaps the precipice of maybe going into some sort of economic slowdown. How deep that will be, I'm sure we all have somewhere on the spectrum of a view that things are going to slow down, but by how much, who knows. And so often what you can do, instead of thinking about, well, what share market's going to be the best, Andrew's talked about high valuations and some of those share markets still looking structurally a little bit weak, Europe, for example, with what's going on there. Another way to look at it is, well, what's the best of a bad bunch? And on that basis, then currency is a nice outlet valve. And I think before I pass on to you, Mark, to sort of talk through perhaps how we think about currency, it's an outlet valve not just for views around economic slowdown. It's an outlet valve for news, and I think it's probably a good time to mention the passing of our head of state, and no matter what you feel about what the monarchy for New Zealand, it's still a massive event for the UK and for the Commonwealth. For most of us, she has been our only monarch, and a real sense of stability. And now I don't mean to always go back to financial markets, but the first thing to react when her passing was announced was the pound weakened. Now it does end up normalising and bouncing back, but it's a pretty amazing testament when someone passes that their currency weakens, because there's that sense of stability going. But I think currency often does that, doesn't it? Big events, the first thing you look at is what's going on with currencies.
Yeah, well, I think I often describe currency as the shock absorber of your car. It is the way. It is the sort of the external instrument that can respond really quickly to events and has that nice effect, much like a shock absorber of the car. Rather than having a pointed impact, it does spread the load across the whole economy. But coming back to the sort of start of the question, I think, the reality is when the world's sort of more normal, and especially when things like monetary policy and interest rates are not really doing a lot, you don't get a lot of differences in currencies. In that sense of, nobody's raising rates, currencies are kind of going to be pretty boring. But you look at this year and, the extreme you've had very large changes in the way in which interest rates have moved around the world and for very different reasons. And in the extreme, you look at, say, somewhere like the US versus Japan. Japan, an economy which has got a degree of inflation, but nothing like we have. They definitely want to continue to actually probably encourage inflation, given they've had sort of decades of borderline deflation. So they are still keeping their interest rates, and especially their long-term interest rates, super low. So like a 10-year government bond in Japan is 28 basis points versus 3.2% in the US and 4% in New Zealand. That's meant you've had this massive dislocation between where interest rates are, and that has been expressed really in the currency. And the Japanese yen versus the US dollar has gone from circa 105 at the start of the year to, or below 105 to 145. So a massive devaluation of the Japanese yen. And you're seeing that around different areas. New Zealand dollar has struggled generally because the US dollar has been the least dirty shirt in the washing pile. And it's been strong. So that's why Kiwi is down at sort of basically 60 cents, the lowest it's been in a long time. We're not particularly negative Kiwi per se, but dollar is king. The one we don't like is Europe, really for the reasons that given the energy crisis, given what's happening in Ukraine, given what's happening in their inflation, it's kind of hard to see an easy way out for them.
I mean, they've had such a bad experience with inflation in the past, probably the biggest understatement ever in their history, and the first thing they care about is quelling inflation, and if that means pushing the currency down and pushing the economy into recession, well, so be it.
Yeah, and certainly, currencies, and it is a topic for another day, but currencies will definitely respond to interest rates, but equally they really look at where growth is, and if growth is not in Europe and it's moving into recession, money will leave and the currency will fall.
So if I can summarise then what we've talked about for the last 56 minutes, inflation is going to stay stubbornly high. It will come down, but it will still be higher than the target rates, which means interest rates have to keep driving up. And I think on that basis it causes two things. It causes opportunities within being able to, if you have the tools, like NZ Funds does, to mitigate those rising interest rates. But on the other side, there's also some great opportunities in bonds where you're starting to get a great yield and be rewarded for the risk that you're taking within that asset class. At the same time, within a bond portfolio, you can be active within the currencies, and that can also help with the fact that there's pressure on those interest rate changes, and that gives you a diversification in returns that is not overly risky for that part of the portfolio. Yeah. From an equities point of view, Andrew, I think we could spend 3 hours arguing if it's going to go up or down, and I think that probably says two things. One, it's a stock pickers market. You're going to be spending a lot of your time researching companies and trying to decipher which ones are going to perform in this sort of environment. That's pretty exciting. We've even added more resource to the team to help with that because we see the opportunity set as really high. But it's not just about share markets. Share markets will end up, over the long term, generating the majority of returns for our growth and inflation portfolios because equities are king. They compound over periods of time. But in times where you can have this sort of volatility, there are other asset classes that we can also look at to generate returns, and I think your commodity setup sounds pretty exciting. What we haven't talked about is other asset classes outside the listed market, and perhaps we can save those for another day, but some of them will come up within the quickfire questions. So for in the next minute, off the top of your head, Mark, does New Zealand go into recession?
I think it's probably pretty likely, or it might be, as always, there's two answers, but it might be a split recession, an urban recession, but actually rural New Zealand to be quite strong. in the sense of urban really gets hit with mortgage rates, which have massively changed.
Property market in New Zealand still goes down?
Tough, very tough, just because of where, as we've talked before, was it 2.5% mortgage, now it's 5 and change or higher, so that definitely changes the dynamics.
This is an unfair one, Andrew. Share markets up or down for the next 6 months?
I think we'll see both. I think we'll see new lows, but I think we may not end the year at the bottom.
And commodities overall, positive place to be?
Selected commodities, yeah. I think you need to be careful in the cyclicals, and agriculture will look good. Roll out 2-3 years, positive place to be. But yeah, careful on oil and metals for the next 6 months.
And then perhaps a really unfair one, because we talked a lot about some of the companies you're negative about. What's some exciting companies that you're looking at the moment?
One that we've liked for the last 18 months is uranium producers, companies that are producing the fuel that's going to nuclear power stations, because we're not getting enough fuel out of natural gas or energy out of natural gas and oil anymore, and it's sort of the lowest carbon way to produce more energy. And I still haven't changed my view on that. I think the setup there is looking actually better than it's ever been. I think the other type of companies that are doing well is the fertiliser space, which I talked about before, because you need those inputs to produce better yields and crop yields, which is so important to feed the world. And then I'm going to be quite boring here and say infrastructure, gentailer type of businesses, quite boring businesses, the type of businesses that don't usually go up 100% in the space of 6 months like technology companies, but these companies in this environment of high inflation, they've got really important assets, they've got kind of big asset bases which are going to become more valuable because they're producing such important infrastructure for the world right now, and you're producing energy and all of that, and you can't replace it easy. So I think that's another great space to be. So those three sectors are areas that I'm spending time on.
And that other asset class that a lot of people have dismissed as, told you it wasn't going to last, it was just a flash in the pan. But actually, what an exciting asset class crypto is. It has come off no more violently than the tech stocks that you've been talking about. Is there a place within the cryptocurrency asset class within the portfolios, and what do we need to see to reinvest back into that sector?
Yeah, I think the crypto sector is still maturing, and we're seeing that it's taken leaps ahead over the last couple of years in sophistication and type of products and non-fungible tokens, which people talk about now, and no one would have even known what those were 18 months ago. Still may not know what they are. What's been the drag on of the last sort of 9 months or so has really been the risk-off environment from investments. So as interest rates go higher, you see risky assets sell off. So some of your most exciting technology companies have sold off 80 or 90%. They've sold off some companies and good businesses have sold off more than in cryptocurrency. And I think cryptocurrency is not immune to that by any stretch. It's still a developing asset class. It's still seen as higher risk, and I think that's why it's going through a little tough period at the moment. But I think what keeps us sort of long-term positive is it's still developing. It's providing sort of a differentiated service and a solution which is going to stick around and have a purpose for the next 5 to 10 years and more. It's hard to predict what it's going to be doing in 15 or 20 years. And I know James always talks about the internet in 2000 and how it took people so long to kind of realise how important that was going to be. And I think you look at crypto sector, it's in that transition at the moment. And for me, to get where I see that maybe the price has been able to sustainably move higher again is probably when we get to that point of interest rates has sort of found their top. We're talking about and this goes for many asset classes. This is also share market. This is particularly technology companies. This is crypto assets like Bitcoin and Ethereum. When interest rates are rising, it's hard for their prices to continually move up. And so one thing we know for certain is interest rates will stop rising at some point. Whether that's in 3 months or 6 months, they will stop rising. And
I think, being the older member of the team, looking back at 2000, you knew then, or it was obvious then, that internet was a really big deal. You just didn't kind of know how. And there were plenty of companies that didn't survive that tech crash. But there's your Amazons and things like that, maybe not even quietly, but just kept working on doing what they did and became the behemoths that they are today. So,
and now we're recording a podcast that's going to go on Spotify and broadcast it on Facebook.
Exactly. So for a similar reason, I think it's really important that we may not have we might only have half a basis point or 1% of our client money in crypto, but it needs to be there just to make sure that we're part of that development of a really exciting asset class, that it will be important.
This has been the Monday Call, brought to you by NZ Funds. New Zealand Funds Management Limited is the issuer of the NZ Funds KiwiSaver scheme, the NZ Funds Managed Superannuation Service, the NZ Funds Advised Portfolio Service, the NZ Funds Wealth Builder, and NZ Funds Income Generator. A product disclosure statement for each is available at nzfunds.co.nz. Past performance is not necessarily an indicator of future returns.